Hi guys, I'm Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I'm here with your Cabot Weekly Review. I'm recording this on a blustery Friday here in Rhode Island on Friday, January 14th, and it is right around 12 o'clock noon. So, another kind of interesting week. It continues to be a similar story. It's sort of this, growth is weak, value is strong, large cap tech continues to be strong, although we saw a few cracks under the surface there this week. It all started off, Monday was, pretty sketchy day, to be quite honest. Monday morning was weak, and then as we went on throughout the day, we saw technology stocks come back, close, the NASDAQ closed just up, barely in positive territory on the day, and sort of thought that would signal some continued strength throughout the week, as it does seem as though a lot of these growth names are oversold. Unfortunately, that was not the case, and a number of names took another step down yesterday and have been a little on the fence today. So it just continues to be a pretty challenging environment for the real growth-oriented investors, especially those that are in smaller and mid-cap names that don't yet have positive earnings. So we're going to go through a number of ETFs today, kind of look at some of the things that are going on high level, and then of course you can dig into the ETFs to pick out individual names. But just turning to the chart here again, we're using Panarray from William O'Neill, which is a solution that supports a lot of the research I do for Cabot Early Opportunities and Small Cap Confidential. As you can see, S&P 500 4% off of its highs. Nothing really new there. Continues to find support. Kind of this pattern of higher highs and higher lows. As we move over to the S&P 600 small cap index, again, similar story here. It basically has been moving sideways since, February or March. The big move in 2021 for small caps was early in the year, kind of a continuation of the strength that we saw in late 2020. But it's really been just a nothing burger since then. I do think that the bias here is to the upside once we get through Omicron and potentially into a more sustained economic reopening in the U.S. But it's hard to, gauge that. Of course, there's a lot of stocks in here, and a lot of them are doing different things depending on what's going on out there. Back to the NASDAQ. As you can see here, this blue candlestick was Monday, where we fell briefly below the 200-day moving average line. It was a bit of a sketchy day, as I indicated earlier, but we did close up, and then a little bit of a follow-through on Tuesday and Wednesday, and then a retracement on Thursday, and then today we're right back on this kind of feels like almost a make or break day. Of course, we do have a long weekend coming up, and so I would say if we can close, around where we are now, around break even on the day, that would be a positive. So let's jump into some ETFs and some individual names here, and we're going to start with areas of the market that are doing well, that have done well recently. Of course, it's no surprise to anybody that energy is up. So we have the Xle Etf here, which is making another new high. Now the question with something like this is, are we getting a little extended? Is there going to be some selling next week after the cold weather moves through? Who knows? But if you're into energy, you've been in the right place. And of course, if you're into individual names, you can go into an Xle type ETF and pull down pull up the names within the ETF, which for here, there's no mysteries to any of these names. For me, if I want to get into energy, I have been watching the small cap ETF, which is the PSCE. That would be the S&P Energy Sector ETF from Invesco. And in here, again, if you want to get into individual names, you can do so looking at like a PDC Energy or Range Resources RRC. Feel free to pause the video if you want to take a screenshot or look through these names. I don't cover any of these right now, but again, if this is where you want to be, sort of on the more aggressive side of energy than some of these small to mid cap names might be where it's at. Another area of the market that has been doing reasonably well lately, the semiconductor stocks, again, kind of goes back to this big picture theme of semiconductor shortages, but strong pricing. And there is also some capital investments being made in the space. So the Sox ETF, SOXX, is kind of the one to look at here if you want to just play the trend. Again, if you want to get into individual stocks, you can pull up the ETF name. Feel free to pause the video here. Again, it has the top 10 positions in this with Avago, AVGO, Nvidia, NVDA. In fact, let's jump through a few of these just to see how they're doing. So here's Nvidia. A little bit of a pullback over the last month and a half, 22% off the high. On Semiconductor has been one of the stronger ones, ticker symbol ON, market cap of 28 billion now. I believe that some of the other Cabot analysts have been following this stock. And KLA, semiconductor equipment company. Again, kind of that play on investments, capital investments in the semiconductor space. That one has been doing really well. And if we move into the small and mid cap space, Nova Limited has been one that's been on my radar. NVMI, market cap of almost 4 billion. Chart tells a pretty good story. It's just above the 50-day moving average line here, about 7% off the high. That's Nova Limited. And then in terms of an actual semi-name, we have SiTime. When I say semi-name, I mean a fabless semiconductor designer. SiTime, ticker symbol SITM, with a market cap of just under 5 billion. It's 33% off of the high, but that high was a spike here back in mid-December. And kind of looking at this support line, hopefully it holds around 225 if you're in this stock. That would be something to watch. If we break down from here, the next area would be this sort of 190 type area. And then below that, it gets pretty ugly. Hopefully that doesn't happen. But anyway, that's SiTime. Moving on. Another area of relative strength lately has been financials. Again, with interest rates climbing, there's been a lot of analyst coverage of financials, which higher interest rates should be good for these companies. Earnings season has begun. So as we get into next week, there's going to be a lot more news on financial stocks. The Xle Etf is the ETF to play here. And as I mentioned before, you can pull it up and look at the individual stocks. For me, I kind of tend to look a little more closely at individual names in the small cap financial sector ETF, which is the PSCF. Here's that. If you want to take a look at those. The small cap ETF hasn't been as strong as the large cap one, but I do think that if we get a bigger move in financials, that we could start to see the small cap financial ETF do real well, especially, again, if we get into this more sustained economic reopening when Omicron passes, which hopefully it will soon. Then in terms of other technology related names that are doing well, so the networking space has been relatively strong. Again, there's a lot of capital investment being made in networking. We talked about Cisco earlier in the week on an internal Cabot call with analysts, which has been a name that's been performing relatively well. Of course, it's an old name, but if you want to take a look at, if you want to play sort of a networking infrastructure theme with an ETF, then check out the iShares IGN. And then, of course, you can go into that and pull out individual names. But as you can see here, if it's a pretty easy way to get exposure to Cisco, Arista Networks, F5, FIV, Ciena, and on down the line. So let's move over to some of the names that aren't doing so well. So if you're not into the momentum, into chasing the financials or energy or networking type names, you're looking to buy on a pullback, then no better place to look right now than IPOs and software stocks. So the Renaissance IPO isn't, my favorite IPO in terms of my favorite ETF in terms of a long-term growth-oriented type, ETF. But for right now, it serves its purpose, which is to give exposure to both IPOs, recent IPOs, as well as some software exposure, growthy type names. So we look in here, we have Uber, Snowflake, Datadog, CrowdStrike, Zoom Video, Cloudflare, Coinbase, Palantir, Airbnb, Bill.com. A lot of names that we've talked about that were doing really well when growth stocks were cranking and have just been demolished, down 30, 40, 50% in a lot of cases lately. So this is a way to play that without having to take stock-specific risk. And then, of course, if it does well, can take on more stock-specific risks by pulling out some of these names and just buying the stocks directly. So that's the Renaissance IPO. In terms of where it is at, as you can see here, we're back to the 49.50 level where it was in October of last year. So it's 36% off the high. If we jump out to the weekly chart, it obviously doesn't look great, but not all that different from similar pullbacks in the past. Kind of think about growth retracements of 30 plus or minus % as being somewhat normal, and that's around where we're at right now. And then last but not least, if you're interested in more of sort of a cloud software ETF, then you could do, I have a couple of charts here from the IPO ETF just to illustrate how we are kind of at feels like a little bit of a make or break moment for a lot of these names. So here's CrowdStrike, which is trading around 173 today, which is a support zone back in, let's see, March of last year, as well as I guess May was a little bit higher, but again, if CrowdStrike goes lower here, it seems more than likely that it would go back down into the low 120 type range. Similar story for Cloudflare, ticker symbol NET, which at its current level around 98 is almost in line with where it was back in July of last year. And if we go lower, then it seems like it could be on its way back to sort of the mid 60 type area, which is where it was in May of last year. Bill.com, sort of similar story, 175 here, which is where it was last July. And again, further breakdown could signal down to around the 128 area. But of course, if these names firm up, quite a bit of upside. Bill is 50% off of the high, which I wouldn't expect to run back to that level anytime soon. But in terms of buying names like these, if you can stomach the volatility, which I expect will continue for a little while here, it could be an interesting time to start averaging in or averaging back up if you've been taking incremental profits on the way down here. As long term, I think these investors will come back to these names once there's a little bit more of a risk-on type mentality. It is typically going to be those names or these types of names that are higher growth, that might not have positive earnings, that are going to rally the most when we do get into a little bit of a snapback rally or risk aversion wanes and investors start doing a little more risk-on type trading. And then Datadog, I think, is the last name I have here. Kind of a similar story as the previous ones. Oh, we have Snowflake as well, right around its 200-day moving average line. And then finally, for a more cloud software specific ETF, if you wanted to do that, you could come up with the Wisdom Tree Cloud, WCLD, which is trading right around its May 2021 levels. Panerai doesn't have the top holdings from here, but I wrote a number of them down. Again, just go to the Wisdom Tree Cloud ETF website and you can pull up the top 10 or even all of the positions. But what we have here is we have New River, MIME, M-I-M-E, Tenable, Qualys, Snowflake, Workday, Datadog, Zscaler, and Box. I think those are the top 8 or 9 holdings. Again, it's like IPO. It's not my favorite ETF for playing growth, but right now, given where we're at, if you're interested in these types of stocks, this might not be a bad way to go, just so you can stay away from the stock-specific risk and ramp that back up, depending on what happens here as we get back into earnings season, which will be my final note. We have seen stocks, especially growth stocks, trading largely on, it seems like, negative sentiment lately. As we get into earnings season, I expect that's going to change and we'll get back to stocks trading more on the fundamentals of the businesses, which, you know, many of these businesses are doing very well. As I said, it seems like typically 30, 40, 50% drawdown in these names is kind of typical for a pretty significant correction. So hopefully, as we get into earnings season and we hear more about how these businesses are doing, we can see some support and some of these names start to rebound and move higher. All right, guys, that's it for me. Again, we have a long weekend. Cabot's offices will be closed on Monday. The market is closed. Sounds like it's going to be a cold one here in the Northeast. Hopefully you bundle up and stay warm. And we'll be back in touch next week. Take care.